Hello and welcome back to my channel. My name is David, and I have been a financial analyst for over 29 years. In this video, I will talk about carry trade and analyze the situation in July 2024. Does it still make sense to engage in carry trade? What are the best currency pairs? Many of you know what carry trade is. For those unfamiliar with the subject, carry trade is an investment strategy in the foreign exchange market where an investor borrows a currency with a low interest rate and uses these funds to purchase a currency with a higher interest rate, earning from the interest rate differential between the two currencies. Let me clarify something right away. Carry trade and trading on currency pairs are two completely different things, based on different premises. Carry trade is a long-term investment strategy where, as mentioned, you borrow a currency with a low interest rate and invest in a currency with a higher interest rate. The profit comes from the interest rate differential between the two currencies. It's essential that there is stability between the involved currencies. This means that the exchange rate must remain stable or move in the direction of the purchased currency to ensure a profit. The key to success in carry trade is accurate interest rate forecasting and managing the risks associated with exchange rate fluctuations. Trading on currency pairs, on the other hand, is a short to medium-term speculative strategy. It involves buying and selling currencies to profit from the exchange rate variations between two currencies. This type of trading requires careful market analysis, including economic indicators, geopolitical events, and central banks' monetary policy. In currency pair trading, the exchange rate must move in a favorable direction for the investment to generate profits, often within a relatively short period. This strategy exploits the volatility of the forex markets, where currency prices can change rapidly in response to new information. Sometimes the two strategies can coincide, especially when interest rate hikes are expected in the coming months, creating a dual opportunity. In these circumstances, a carry trade can benefit not only from the interest rate differential but also from favorable exchange rate movements, making both carry trade and currency pair trading attractive. In summary, while carry trade aims to profit from stability and interest rate differentials between currencies, trading on currency pairs is based on speculating on exchange rate fluctuations over short to medium periods. Both strategies require a good understanding of the currency market but are based on different premises and time horizons. In 2022 and 2023, following interest rate hikes to combat rising inflation, it was very profitable to engage in both carry trade and trading on currency pairs. In 2024, the situation has changed. The rate hikes have reached their peak, and some central banks, such as the Federal Reserve and the European Central Bank, are considering, or have already started, cutting rates in response to signs of economic slowdown and moderating inflation. This change can reduce the interest rate differentials, making carry trade less profitable. So, does it still make sense to engage in carry trade? Let's look into it in more detail. The currency to borrow. The Bank of Japan, under the leadership of Governor Kazuo Ueda, has maintained its ultra-accommodative policy. Interest rates remain negative, and the central bank continues its asset purchase program to stimulate the economy. The Bank of Japan has stressed that inflation is not yet sufficiently sustainable to justify a tightening of monetary policy, especially considering the persistent deflation. However, there have been speculations about possible Bank of Japan interventions to strengthen the yen, in response to its weakness and rising import prices. Nevertheless, the yen remains today the preferred currency for carry trade. In which currency to invest? US dollar. Federal Reserve Chair Jerome Powell recently testified before Congress, outlining the current stance of the Federal Reserve. The US Central Bank has so far kept interest rates stable, but has signaled a possible rate cut by the end of the year, should inflation continue to moderate. the Federal Reserve is committed to balancing the fight against inflation with supporting economic growth and employment. Powell emphasized that, although inflation has shown signs of slowing, it remains above the 2% target. Currently, as indicated by the Fed Watch tool, the probability of an interest rate cut in the United States by the end of the year is 42% for a 50 basis points cut and 49.5% for a 75 basis points cut. The issue would arise not so much from the lower rate differential, still very good, but from the weakening of the US dollar. Remember that the exchange rate between the two currencies should ideally remain stable, or if there is movement, it should favor the invested currency rather than the borrowed one. However, these percentages can change quickly based on new economic data and Federal Reserve statements. All this makes US dollar to Japanese yen not very attractive for carry trade. Australian dollar. Reserve Bank of Australia, Governor Philip Lowe, recently made statements about the Reserve Bank of Australia's current stance. The Australian Central Bank has kept interest rates stable at 4.35% but indicated that further hikes might be necessary if inflation doesn't fall within the expected limits. The Reserve Bank of Australia focuses on price stability and full employment, closely monitoring inflation which, although declining, remains above the 2 to 3% target. Currently, the probability of a further rate hike in Australia is considered moderate, but the Reserve Bank of Australia has maintained a vigilant stance, ready to act if necessary. This could maintain a favorable rate differential for carry trade. However, it's important to consider that the sensitivity of the Australian dollar to commodity price fluctuations can introduce some volatility in the exchange rate. Additionally, any Reserve Bank of Australia interventions to address lower than expected economic growth could negatively affect the Australian dollar. While Australian dollar to Japanese yen may still be attractive for carry trade, it's necessary to closely monitor Reserve Bank of Australia statements and economic data, particularly the commodity market and exports, to manage the associated risks. New Zealand dollar. Reserve Bank of New Zealand, Governor Adrian Orr, recently commented on the current monetary policy of the central bank. The Reserve Bank of New Zealand has kept interest rates stable at 5.25% but left open the possibility of further hikes if inflation remains persistent. The Reserve Bank of New Zealand is committed to maintaining price stability and supporting employment, with a particular focus on controlling inflation, which is currently above the 1 to 3% target. The likelihood of further rate hikes in New Zealand depends on future economic data, but the Reserve Bank of New Zealand has adopted a cautious approach, signaling that more time might be needed to see the full effect of already implemented monetary policies. Therefore, the New Zealand dollar or Japanese yen remains a good option for carry trade, but with the need for careful monitoring of Reserve Bank of New Zealand monetary policy, climatic conditions affecting agriculture, international economic conditions, such as trade relations with China and other crucial Asian partners for New Zealand, and the demand for agricultural exports. Additionally, the New Zealand economy is much smaller than the Australian economy, making its currency more volatile and risky. In conclusion, while US dollar to Japanese yen has lost much of its appeal for carry trade, Australian dollar to Japanese yen and New Zealand dollar to Japanese yen still offer interesting opportunities. However, as with any investment, it's essential in carry trade not only to consider the potential profits derived from the interest rate differential, but also to be aware of the risks associated with each currency. Fluctuations in exchange rates, economic data, central banks' monetary policies and global economic conditions can all significantly influence carry trade returns. Therefore, it's crucial to closely monitor these factors and have adequate risk management strategies to protect your investments. Thank you for watching this video. I hope the insights shared today will aid you in your trading journey. Feel free to share your thoughts and feedback in the comments below. If you found this video helpful, please give it a thumbs up. To stay updated with my latest videos, make sure to subscribe to the channel and hit the notification bell. See you in the next video.